previous quarter, which I'm assuming that would have been a part of this quarter. If I just make a adjustment, the EBITDA number should be roughly in the range of 270 to 80 odd crores. Would this be like a steady state number, let's say a couple of quarters down the line, before our Zone 4 and PDA capacity is commissioned?
I think it's. I would avoid from commenting on exact numbers, but yes, I think the level of performance that we are seeing right now is what is reflected based on the current strategies that are deployed. So, if we are able to maintain this level of volumes, these are the numbers that someone can assume as a steady state numbers. But I think the objective is sort of not to stay here, right? I think both volume ramp up as well as the cost optimization efforts that we are doing right now should ideally start supporting the business further and potentially compensate for any more volatility that we might see from an end market standpoint, right? So I think, so from a existing business point of view, I think the quarter reflects a decent level of capacity utilization. But at the same time, I think there is still significant work left on the cost optimization as well as further volume ramp up possible from existing capacities.
Sure. Noted, sir. Sir, second one on the PDA expansion, I believe might be an opportune time to make PDA, given that we have an anti-dumping duty placed on Prettilachlor. I believe that would be the end product application of PEDA. Sir, we also had similar initiatives taken earlier from the ethylation unit for S-metolachlor earlier. Are we having any targeted approach towards agriculture, given the family of products is similar? And do we have any export opportunities also in PDA? Since I was just going through Prettilachlor's market, it doesn't look like it's a big market in India, roughly 1,000 odd tons, and we already have one competitor with roughly 8,500 tons of capacity of PDA. So could you explain the rationale and the supply demand in the end product, which is Prettilachlor? Thanks.
No, so I think, first of all, I think the market is much larger as far as our understanding goes. If you look at the entire value chain, because India imports 3 different stages of value chain in this particular product, right? We import DIA, we import PEDA, we also import Prettilachlor. So I think the imports happen at 3 different stages. But I think beyond that, at AIL, we always look at opportunities from a global point of view. I think we enter into a product where we feel we can have global competitiveness and we can have a global scale play. This is one value chain where we are developing end-to-end integration. So we'll start from all the way basic petrochemical building blocks and we'll go all the way downstream. And we also feel that we will be able to do this with a distinctive competitive cost advantage. So that's the logic which we are deploying. So yes, it's a broader value chain play and targeting to build sort of globally competitive presence in that particular value chain.
Sir, any rough working that we could have on PDA regards to economics around it, be it margins or revenue potential?
I won't share product-specific numbers precisely for the reason that it's a value chain play, right? So we don't look at it as a product. We look at it as a value chain starting all the way from aniline to ethylene. And some of it will be a part of existing business, some of it will be incremental.
Sure, noted. Lastly, if I can just have one more. On the Zone 4 capex commissioning that starts from Q4, and then you mentioned that there will be about 5 blocks that will get added sequentially. How do we look at these blocks, sir? Because you mentioned 5, so I'm assuming 5 to 6 multi-purpose plants, but any block dedicated towards a particular chemistry or a product, just to understand a little bit more of nuances on this with regards to its application area or any industry exposure that it could have. And given that we'd also spoken quite a bit on CDMO opportunities, are these also targeted to meet those kind of demand that can come up in the future? Any color on this would be helpful. Thanks.
So I think So not all of them are multipurpose blocks. The first unit that we will commission in the next quarter will be a multipurpose unit. Beyond that, the blocks are sort of chemistry oriented blocks, without getting into too much technicals, but it's kind of a photochlorination block, hydrolysis block, nitrilation block. These are the kind of chemistry block which allow us to make any product using that particular type of reactions, right? That's how the blocks are designed for, which will get sort of sequentially commissioned. There will be different products that can be produced from these blocks, which will have to be optimized on a time-to-time basis based on what is the margin profile and demand-supply profile for these products. That's one. Sorry, what was your second part of the question?
The CDMO bit. CDMO, it's been quite some time since we have had our contract. Yeah,
I think so. We've started our work in that dimension. I think we have good initial success. But I think currently where we are is we are getting to know and build relationship with some of the global innovators. I think that's where we are. As we speak, I think we are doing sort of 3 or 4 projects which are at kind of R&D level. So I think the focus remains on building relationships with global innovators and trying to get sort of involved in a very early part of a development cycle. That work is going on well. That work converting into a concrete, large-scale business in terms of manufacturing or supplying of a particular intermediate/chemical, I think that's kind of a 18 to 24-month journey in sort of our sense.
Sure, noted. And sir, must admit the quality of disclosure and communication has improved significantly. So thanks for that and all the best for ensuing quarters.
Thank you.
Thank you. We'll take our next question from the line of Rohit Nagraj from 360 ONE Capital. Please go ahead.
Thanks for the opportunity. So first question is on the M&A strategy. So earlier we had indicated that since we have a large presence established in the Middle East, we'll go for US, given that US is a gas oil market, whereas Europe is a gas oil market. And now there is a change because of the US tariff situation. Obviously, we did not anticipate that. But how do we look at it from a change in strategy perspective and the benefits that we were likely to get accrued from US? Would it be in similar quantum if we change the strategy to Europe and further into the Middle East? Thank you.
I think the thesis still doesn't change. I think US still remains the largest gasoline market. I think we won't be able to change, that thesis/fact because it's natural. I think it is the biggest market for gasoline. Yes, the trade barriers did impact, sort of our strategy in US. And in that context, we had to figure out some alternate market where I think the teams have been able to do a decent job. But we continue to focus on US. So I think we will also see resumption of volumes going to US in this quarter, despite tariff uncertainty. So that gives us confidence that in the long term, as the India-US trade deal stabilizes, I think potentially it will remain one of the most important market for this product. At the same time, we continue to develop globally because it's a product. As we say, it's sort of high potential product. So the market efforts to develop markets across regions, including Europe, including Middle East, including Africa, they continue to remain on track.
Sure. Second question, just bookkeeping question. So this year our capex will be 1,000 crores. What will be the likelihood of capex for FY27? And similarly, a tax rate for FY26 and 27. Thank you.
So capex for next year will be substantially lower than 1,000 crores. We don't have the right numbers. We are still yet to work out the numbers, but it will be substantially lower. On a tax rate, I anticipate FY27 we should be somewhere between at a number below 15%. FY27 we should be between 15 to 20%. That's a rough estimate right now.
Fair enough. Thanks a lot and all the best.
Thank you. Next question is from the line of Aditya Khetan from Smith's Institutional Equities. Please go ahead.
Yeah, thank you, sir, for the opportunity. Sir, first question on the DCB, we are witnessing a quarterly jump despite muted uptake in dyes and polymers. Any specific reason, like other segments where we look NT, NCB, all have been muted, that is understandable, but on DCB we have seen an uptick. Any specific reason, sir, despite end users remaining muted?
No, so I think on a DCB, you have to look at it both on quarter-on-quarter and year-on-year numbers. I think if you see year-on-year numbers, they will actually be negative. But quarter-on-quarter numbers are positive because the first quarter was actually very weak for DCB chain. And it's also one of the chain which did get impacted because of US tariffs. But I think we've revised our strategy for DCB. And that's one chain where we expect sort of very strong second half. So you will see volume growth in that particular segment, irrespective of what happens to US tariffs over the course of next 2 quarters.
Okay. Sir, onto the MMA, when we look in this quarter, like the contribution from the energy segment is around 43%. Considering we are doing some debottlenecking and taking it to around 3 lakh tons, you see like the contribution to be around the 50% from energy segment. And does this pose any risk to our long-term spreads per kg or spreads per ton, like what Aarti used to enjoy earlier, spreads per ton, that will be materially lower if energy segment picks up more from the current levels? Any thoughts on this, sir?
So we don't actively, frankly, at this point in time, we are not actively managing exposure to a particular application segment, right? We have certain assets and we have certain capability. Right now, the focus remains on how do we sort of utilize these assets to the best possible extent to deliver the best possible financial performance. As I mentioned in some of the earlier conversations, the contribution levels at a broader portfolio level across applications have started to converge. Now, they will get reset over the course of next 1 to 2 years, and we do that optimization on a dynamic basis. But ultimately, the objective will remain that, so how do we maximize the net contribution for the company across different applications while utilizing all of our existing assets. On a steady-state basis, again, we mentioned it previously, we feel, given the entire Zone 4 new capacity, new products will also come on stream over the course of next 1.5 years. I think the energy as a segment, ultimately might settle down somewhere in the range of 30 to 40%.
Okay. So just one last question. Sir, onto the US tariff, we have indicated that there was no pain we have witnessed in this quarter. You see any significant dip in volumes from the US market in next quarter, and materially we could be lower from this quarter?
No, I think we did witness pain from the US in this quarter. I think our share of US business in the last quarter was significantly lower compared to Q1. So there was definitely a pain. I think it was offset by, push in the other geographies. So I think, but potentially to the level where we have already reached, I think the further downside is sort of can be arrested. In fact, there could be a positive trigger if we get sort of stabilization in the India-US trade deal.
Any tentative figures, sir, of the volume loss or the revenue loss from US?
There is no revenue loss because I think that volume has been actively placed in the other markets.
Okay, got it. Thank you, sir.
Thank you. We'll take our next question from the line of Abhijit Akela from Kotak Institutional Equities. Please go ahead.
Good afternoon. Thank you so much. Just with regard to the cost-cutting part of the guidance that we've spoken about. So this 150 to 200 crores is now mentioned as fully completed. Is this in the base in terms of the P&L numbers that we see, the expense numbers, or is some benefit yet to flow through in coming quarters?
No, there's a lot of benefit yet to flow through, especially, one of the major item there was around sort of renewable power purchase agreements. A large chunk of it is expected to get commission only in April 2026. So that is a significant benefit that will flow through in the next financial year. There are also certain long-term contracts for raw material where sort of new pricing formula gets set in. I think those are also yet to flow through to the bottom line completely. So in terms of actions, I think the activities have been completed, but from a benefit point of view, there is a decent chunk of it which is yet to flow through in the bottom line.
Any sort of numbers you could put around that? How much of this 150 to 200 is in the base versus how much we should expect? next year?
Difficult to say. It's also a continuing journey, right? I think we had given a number of 150 to 200 crore for which I think the action is completed. I would say roughly 40 to 50% of it is yet to flow through in the bottom line. But given it's an ongoing journey, we hope to also continue to add more initiatives to that funnel. And to some extent, it's also volume linked, right? Because many of these are variable cost reduction initiatives. So ultimately, if the rupees per kg cost is down, as we increase the volume ramp up, automatically the cost saving benefit also gets multiplied accordingly.
Got it. Thank you. And just one other thing on the tariffs. Any color if you could please put around the sort of conversations that customers are having, US-based customers, regarding maybe the sharing of the pain, So, is the tariff burden basically being shared? How are things evolving on that front, and how you see them going forward?
I think in near term, it's in the interest of both sides to figure out a workable model. But at the same time, we remain sort of cognizant of the fact that, if the situation doesn't get resolved, then there would definitely be some long-term impact. As we see, based on the current situation, it feels like China has a preferred trade arrangement even than in India in today's situation. We hope that will change very soon. But so far, I think we have been able to hold on to the conversations, and I think all the customers also remain sort of actively engaged. But yes, people will look forward to getting clarity over the course of next few weeks to ensure that they lock in their plans for the next year.
Okay, got it. Thank you so much, and all the best.
Thank you. We'll take our next question from the line of Vivek Rajamani from Morgan Stanley. Please go ahead. Vivek?
Hi, sir. Thank you so much for the presentation. Just a couple of clarifications on the tariff bit again. I think you mentioned that you've already reduced the share of volumes to the U.S. This quarter and offset it with sales to the other regions. So would it be fair to say that if this tariff situation resolves whenever it does, the volume impact may not be significantly high because it could just be a case of you moving the volumes to the U.S., or there could still be a more improved volume performance should that happen? That's the first bit. And second, if you could just also touch upon, X of tariff, the volumes going to the U.S., do they have a better margin profile vis-a-vis your volumes going to the other geographies? Some color on that would also be helpful. Thank you so much.
The answer to the second question is yes. I think X of tariffs typically, we've enjoyed better margin profiles in U.S. than other geographies. I think the first part of that question, the answer sort of changes from value chain to value chain. So if you look at, something like MMA where, if you're operating at, 90% plus capacity utilization, then opening of US market will not change the volumes. It might change the margin profile, but it will not change the volumes because anyways the capacity utilization is to a decent level. But there are some other chains like phenylenediamines, like DCB, like ethylation, where the capacity still exists. So I think opening up of US market or making it more sort of accessible based on reasonable tariff arrangements will help us also push incremental volumes.
Sure, sir. That's very clear. Thank you and all the very best.
Thank you. We'll take our next question from the line of Surya Narayan Patra from Phillip Capital India. Please go ahead.
Yeah, thanks for the opportunity, sir, and congratulations for the great set of numbers. My first question is on the, let's say, the MMA. So, within a year, you are just almost like tripling the capacity. Can you give some sense what incremental confidence that you are having on this product segment? And now, with the diversification, whatever that we have seen from the GCC market to other, so what is the split between GCC plus other for MMA currently?
So I think overall, we remain again very confident about the market potential of the product. That's the reason, further debottlenecking efforts underway to increase the capacity. From a regional share point of view, at this point in time, we would not address it because right now it's frankly driven a little bit by the current geopolitical situation that we are facing. I think we will reach to a little bit stable global footprint position in, let's say, 6 months down the line, where we have a resolution on the US-India issues. At the same time, we have good feedback from current expansion activities that we have done in, let's say, Europe, Middle East, and Africa. So we'll reach a steady state potentially 6 to 7 months down the line. But the only thing we can say is that we do have a presence practically in sort of all major blending markets in the world.
Sure. Second question is on the upcoming projects which are likely to drive profitable growth for you the way that you are indicating. So any of the upcoming projects, whether it is the multipurpose plant or the PDA or the other set of projects, so any of them, whether that has been backed by a customer and hence the implementation of those projects or execution of those projects would not be deferred or delayed?
I think we've moved past that industry phase, to be very honest. I think there are very rare instances where these are kind of sort of back-to-back customer committed with take-or-pay kind of contract kind of commitments projects. Yes, in all of them, we do have very active conversations with customers, and we do have decent relationships and conversations in place, which gives us confidence to place the molecules. But if your question is specific to that, whether we have a take-or-pay contracts for any of these products, then the answer is no.
Okay. Sir, even then, can you give some decision, because this multipurpose plant is a kind of a project which can encompass so many projects, but we may not be having any sense about it. So just since it is coming in the fourth quarter and it would be very much there in next year and following year as a kind of earning driver for the company. So if you can give some color to it, that how things will really shape up for this project, that would be helpful.
So I think, PEDA is a classic example of MPP, right? We saw the opportunity in the market. I think sort of 80-90% infrastructure already exists in terms of multipurpose plant, and you have to do sort of final tweaking to get the asset ready to sort of deliver on a certain product in a certain value chain. Your time to market goes down significantly. I think the way we look at MPP is a flexible asset which reduces our time to market for new innovative products significantly. So it's been looked at as a capability rather than necessarily, as a NC or as a net contribution engine. Once we get into the market, stabilize the product, we have two choices. Either we can continue to manufacture that in sort of one of the MPP setups, or if the volume sort of ramps up and we see significant market development, we could potentially also build the dedicated, assets for ramped up chemistries. So the way we look at MPP is a tremendous capability which accelerates time to market and at the same time gives us opportunity to try out innovative products at a lower cost.
So is it fair to believe that, sir, the vast R&D capability and investment what you have already created, so this MPP is a forward integration to those R&D capability?
Yes. So I think that's where CDMO efforts will also come into the play, because if you look at the overall pipeline that we have built, right, we have a great R&D setup. We have now 2 world-scale pilot plants which have already got commissioned. Then we have a multi-purpose plant which was kind of a missing piece in the overall chain, and then we have a dedicated chemistry block. So I think our ability to serve global partners across the different stages of development and different stages of a market product evolution is going up phenomenally with this asset addition to our capability.
So, sir, just one bookkeeping question for Chetan, sir. Sir, you mentioned that there is a 34 crore kind of forex loss sitting in the finance cost line. So this 34 crore is excluding that 15 crore forex loss number that is there in the line items. Am I right?
Yeah.
Okay.
So
And
sorry, go on.
Yeah, please, sir.
So 34 crore is related to the long-term ECB which was taken from IFC, and the 15 crore comprises about the impact on the short-term working capital export finance like packing credit and other stuff which is taken. It actually also gets netted off against the positive benefit on exchange which is part of revenue from operations to the extent of around 25 odd crores.
Sure. Okay. So then when this 2-3 project that is going to be commercialized in the second half, what is the kind of spike in the finance cost that we can see on a quarterly basis or in whichever way that if you can give some clarity? That is one part. And also if you can just give the export number for the quarter.
On the finance cost, there will be some increase which will come through because this project will also start taking in the initial period. The contribution to EBITDA would be quite limited. There will be working capital which will go through. I don't have a right number in terms of what is the increase in the finance cost which should assume. I'm also anticipating a bit of softening of interest rate going forward. So that should support in terms of not moving the finance cost significantly up. On the export numbers, I'll probably come back to you.
Sure, sir. Thank you. Yeah, wish you all the best, sir.
Thank you. We'll take our next question from the line of Tushar from Omega Portfolio Advisors. Please go ahead.
Yeah. Good afternoon, sir. Thank you for the opportunity and congratulations for a great set of numbers. So I just wanted to know, in the MMA, which is contributing upwards of 40%, will that maintain going forward? That's the case. That's the first thing. And secondly, so we are very confident on the MMA. Just wanted to know our right to win in India in the global market in the MMA business.
So I think from a manufacturing point of view, we feel we have one of the largest and sort of most competitive capacity for this product. I think there are several innovations that we have done on technology front, which also allows us to sort of play in this market against competition. And third, we are genuinely investing a lot in building a supply chain infrastructure as well as creating very deep customer relationship with the large global players. At the same time, on the volume confidence, I think the confidence of manufacturing and placing the product is sort of demonstrated also in the quarterly performance. At the same time, we have to understand that there is an economics linked to global oil and gas sector trends and a certain support from differentials available for gasoline and differentials available between gasoline and naphtha do have a fundamental impact on the demand for this particular product in the global markets. So with the understanding of that context, I think we still continue to remain excited and we continue to expand both market as well as our capacity.
Fair enough, sir. And in the agrochemical, considering the second order effect, do you see the agrochemical global picture in terms of volume is improving going forward?
So I think at a global level, volumes for sure have seen some recovery, but the margin pressure remains quite intense. I think if you look at India-specific picture, we are starting to see some second-order impact of some of our downstream customers who are exporting to U.S. I think some impact was visible in the last few months. But at the same time, I think so everyone is hopeful of settlement on that issue and sort of the long-term issue of inventory-linked pressures which were having overall impact on the consumption or the volume growth itself, I think those are sort of mostly settled.
Got it, sir. And sir, in terms of your margin profile, this 14% margin, do you see the structural one going forward or it just depends on the price movement in terms of the margin?
No, I think, as I said earlier, I think for us right now, the biggest needle mover is the operating leverage. So if we are able to, maintain and sustain the volumes at this level, then the operating leverage kicks in. But however, I have to also admit that the volatility in the market, both in terms of raw material and the product pricing, still remains at a very elevated level. In the last 6 months, we have seen significant volatility in raw material, and that also corresponds to product prices in a lot of other segments. So we remain watchful of that. But I think at a generalist answer level, the current volume levels will support, the operating leverage-led increase in the margin.
Okay, sir. That was really helpful. Thank you and all the best.
Thank you. We'll take our next question from the line of Siddharth Gadekar from Equirus. Please go ahead.
Hi, sir. So first on the chlorotoluene project, can you just highlight what is happening there and when do we expect ramp up in that project?
I think I answered it partially. It's part of our Zone 4 blocks. And, as we start the next financial year, you will see sequential 5 blocks getting commissioned in Zone 4 over the course of full financial year. All of these blocks are designed and able to produce chlorotoluene value chain at the same time many other products. And we will select the products depending on the market dynamics and the contribution possibilities.
Okay. So secondly, just on the MMA competition, can you highlight what kind of capacities are we seeing getting added in India and China?
I think exact numbers, frankly, are not very specifically available in the market. We suspect there is sort of another 100 plus KT capacity available in India and maybe 200 to 300 KT capacity available in China. Though that's not reflected in the volumes from competition, but that's the kind of capacity that could be available.
Okay, thank you so much.
Thank you. We'll take our next question from the line of Sajal Kapoor from Anti-Fragile Thinking. Please go ahead.
Yeah, hi. Thank you for taking my question. First up is just an observation. The quality of communication and disclosures have improved significantly in recent quarters to you. So well done on that front. Even to read through the annual report, the disclosures have significantly improved. And that's one. And then we have stepped up our efforts in science and innovation. The intellectual property creation effort has increased. All that is good. The question I have is, in an increasingly uncertain and random world, how do you see the balance sheet position? Would you be comfortable with the current debt profile we are carrying on the balance sheet? And what is the plan to sort of try and maybe deleverage amid the current wave of capex, plus the fact that the next wave of capex will be much more focused on fungible, more science and innovation-led capex. So the capex is an ongoing effort. What I'm slightly concerned about is the current debt levels that we have on our balance sheet.
Thank you, Sajal. I think first on the capex side, I think the capital execution strategy has been very disciplined for last 12 months and will remain very disciplined going forward. I think in some of the questions I did cover that. I think in going forward also, if you look at next 2 to 3 years, I think we are not looking at a very blockbuster kind of a capex, right? If something comes our way, we will of course evaluate and sort of come back. But at this point in time, the focus remains on sort of medium-scale capex, which are able to turn around very fast and are able to deliver significant returns utilizing existing infrastructure. So that remains primary focus. And that will also help us manage the overall balance sheet much better. We actually think from a debt to EBITDA point of view, we potentially could have already seen the peak. So we don't sort of, absolute debt numbers are important, but for us, I think what we track more is debt to EBITDA. And I think on that front, we feel that we could have potentially already seen the peak now, and it should improve going forward.
Okay, that's helpful. That's all I wanted to check. Thank you.
Thank you. Next question is from the line of Anil Chaurasia from Smiths. Please go ahead.
Hello, sir. Congrats on good set of numbers. I have just 2 queries. One, sir, what explains the increase in debtor level almost by 65%?
So if you look at the top line has also gone up, and in certain cases, for some of the, in fact, just adding it to the previous question which was there, the export percentage is upwards of 60%, where the credit profile is a bit more as compared to the domestic numbers. So which is where you would see this receivable to be there. So if I combine on an overall working capital basis, the working capital cycle continues to remain at the level what it was. It continues to remain in a range of around 45-50 odd days. The receivable plus inventory continues to operate at a similar level. So there's a reduction in inventory days, increase in receivable days because of the fact that the export profile has gone up a bit.
Okay. And secondly, sir, in cash flow, I think you were explaining that actual finance cost is 159 crore. But if you look at in cash flow, under financing activities, we have reported only 115 crore. So what explains the difference?
So as I said that there is the mark-to-market impact on the loans which has to be accounted based on the volatility of the currency is not a cash flow item. And that is where the cash flow will show the actual cash outgo versus the P&L will reflect the provisioning for those potential volatility impact as well.
So you mean to say last year there was no such item like mark-to-market? Last year it was matching?
Not significant.
Okay. Thank you so much, sir. All the best.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to management for closing comments. Over to you, sir.
Thank you. Thank you everyone for joining us today. We appreciate your continued support. As shared earlier, we are transgressing across the most challenging phase of the chemical sector. I think our resilient and robust strategy helps us navigate this phase and deliver growth and sustainable performances. We hope we have been able to address all your questions. Please feel free to reach out to us if you have any further queries. Thank you once again.
Thank you. On behalf of Aarti Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.